What happens if I take too much money out of my property company? Hi, I'm Kimberly Shapcroft, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. Let's have a talk about what happens if you take too much money out of your property company. Now, you might think, when does this happen? Well, there's many an occasion where you may have taken all of your director's loan account, you might make a profit, or not a profit, on refinancing a property. You might be creating some equity in the company that there's cash sitting in the bank, but you've got nothing to take out. So what happens if you do actually take that money out? There are unfortunately tax consequences when you go into an overdrawn position. So this is where you owe the company money rather than the company owing you money. What are the consequences then? The consequences are something called Section 455. What is Section 455? Section 455 is an additional tax that is placed on companies where their directors have overdrawn directors' loan accounts, which means if you owe the company money rather than the company owing you any money, you will have this tax potentially to pay. So when do you pay this tax? Well, you pay this tax when you're overdrawn after 9 months and a day. So you have to pay the tax 9 months and a day after the accounting period end. But if you actually clear your director's loan account and you're no longer in an overdrawn tax position, then generally you don't have any tax to pay. However, if you are still overdrawn 9 months and a day after your accounting period, then you'll have tax to pay. Now, unfortunately, it is quite a high tax that you end up having to pay, as you have to pay potentially 33.75% tax on the amount you are overdrawn. So if we just say a simple number of 10,000, then if we have tax to pay on that, then we've got to pay £3,375 in tax on an overdrawn balance of £10,000. So that's quite a significant amount, especially if the figure is getting higher. Now, the one benefit I will say of the Section 455 tax regime, it's basically a loan to the taxman. And the reason it's a loan to the taxman is because the idea of this tax has always been that it's just in case you as a director don't follow through and take a dividend or put through a salary, which covers this overdrawn director's loan account. So the taxman basically wants to make sure that they have got their cut of their money. So the tax is based on if you had to pay the higher rates of tax, which is why it's at that high rate. You arguably need to keep a record of your director's loan account so that you can keep track of what you have put into the company, what you have taken, so that you know what your director's loan account position is throughout the year or at the year end. Now, your accountant will generally figure this out as they work through putting your statutory accounts together or from your bookkeeping, so they'll be able to see the position and how it is at the year end. They'll then need to follow through if it is overdrawn to see what has happened since the year end, of when has it been repaid or has it not been repaid since the year end. One positive of this tax, that if you do have to pay it, you can reclaim it back at a later stage. So when that balance does get repaid in a year or 2 years' time, then the positive is that you will get that tax money back. So it's not an indefinite, you lose that money forever. It's a tax bill, but it's a tax loan to HM Revenue and Customs rather than money that you will lose forever. You can therefore reclaim it the period after you have repaid it. So if you repay it after the year end, you don't have to pay it. But if you don't repay it within 9 months and a day, then you've got to wait for a further 12 months and wait for the 12 months and 9 months and 1 day before you can reclaim that money. The key here is that claims do need to be made within 4 years to make sure that you get that money back. So it's something to keep on top of, which generally your accountant should be keeping on top of anyhow for you, but just for you to be aware so that you know that you have this money that you need to make sure you're claiming back as soon as you are able to. HMRC have introduced some useful forms to help with that reclaim, which are CT600As, and Form L2P. So check out those forms if you do need any help, but as I say, generally these are things that your accountant will probably work through for you. The final thing that I need to mention today is if you are overdrawn by less than 10,000, then yes, this is a problem, but it's not too bad. If you, however, go over the 10,000 mark, then there are further implications, and these implications come down to what's known as a P11D, or a benefit in kind form. And the reason that there is a benefit is because if you are not charging any interest and you're doing this at 0%, an interest-free loan, then you've now got a benefit, because if you needed to have, say, 20,000 loan from somewhere else, if you went to a bank or a friend, they'd probably charge you some sort of interest. However, if out of your company you're getting this interest-free, then you've just saved whatever interest rate there would be. So it may be if you went to the bank, you get a loan at 5%. You've now saved yourself 5% on 20,000 for the time that you've had that overdrawn loan account. So this means that HM Revenue and Customs want their fair share of that benefit and the taxable benefit that you have received. So you calculate this on your P11D and you need to report that to HM Revenue and Customs. The P11D takes into account the official rate of interest. So it looks at what is the nation's interest rate at the time, and you can do a calculation to see how much interest that you have in essence saved by having a loan from your company. You as an individual will then get taxed on that on your personal tax return, and the company will also pay Class 1A national insurance on this benefit that it is paying to an employee. Alternatively, to remove this benefit to the individual, you would be able to charge interest at an appropriate rate to that individual. This may not be paid by the individual, I have to say, at this point in time, but it can just increase the director's loan account. Now, that obviously makes the Section 455 position worse, but it does remove the reporting requirement for a benefit in kind for a P11D by charging interest, because at this point you would then not be incurring any benefit by having that loan with the company. The key there would be the Section 455 would be slightly different as the interest accrued through the year, through the time period. But hopefully it may solve one problem, maybe not the other. One of the key takeaways I'd like you to have from today is that if you are overdrawn, then there are tax consequences. However, if you can make repayment of any overdrawn loan accounts within 9 months and 1 day, then you can remove this additional tax consequence. So it's something to be aware of and to work really hard to try and do, as then it will be saving you quite an amount of tax that you may have to pay. Hopefully today you've discovered what Section 455 tax is and how this has an impact on you and your property business if you are taking more money out than you should be. If you have any questions, then please do leave a comment. We can cover more about this topic to help you understand and ensure that you are running your property company in the best possible way. Please like the video and please do subscribe to the channel. Let's make tax less taxing. Let's make tax less taxing.